Let's talk about emerging markets equities. Trade tension and uncertainty surrounding trade issues has caused emerging markets equities to underperform developed market equities, the market more broadly. The concerns center on, for the emerging markets countries, on supply chain disruption or direct impacts to export viability for a number of these countries. In addition to that, U.S. monetary adjustment from accommodation to neutral has been carried out through predicted but successive U.S. Federal Reserve rate hikes. This has happened in an environment where the Japanese Central Bank and the European Central Bank continue to carry out quantitative easing, continue to buy government bonds in Europe, albeit at a lower rate. But on a relative basis, with the rate increases, U.S. Treasuries trade at a yield higher than that of the other developed markets. And with trade tension uncertainty, combined with trade tension uncertainty, the United States being seen as a safe haven currency, and as the U.S. dollar is a reserve currency, the U.S. dollar has appreciated vis-a-vis most world currencies, but particularly emerging markets currencies. This becomes a problem for the emerging markets countries where they've had higher levels of domestic debt, inadequate foreign reserves, a trade deficit, and higher absolute levels of indebtedness. Countries such as Turkey and Argentina have experienced a true economic crisis. Meanwhile, other emerging markets countries that are in much better structural shape or have been able to weather the storm, countries like Korea and Taiwan, are in much better condition. Overall, we find the emerging markets to be very attractive, in part due to a very favorable demographic profile. Certain emerging markets countries like India, Mexico, and Brazil have a young workforce. They have more new entrants entering the workforce and fewer elderly as a percentage of the total population. This sets the stage for several decades of economic expansion and allows governments to deploy tax revenues in infrastructure investments that enhance productivity as opposed to expenditures needed to care for the elderly. When considered against the United States, Japan, and Western Europe, it's a stark contrast where the aging demographics in these rich world countries are going to put a lid on potential economic growth. The burgeoning middle class in Asia largely is extraordinarily impressive. The rich world is going to see very, very slight growth in middle class expenditures. And meanwhile, the emerging markets countries are going to see significant growth, and India and China, namely, are expected to see 6% annual growth in middle class expenditures, and this is off of a 2.5 billion combined population between these two countries. When taken into account with other Asian countries, that population number pushes up over 3 billion. So it's sizable and growing rapidly and creates a very solid backdrop for investing. In 2014, the emerging markets group exceeded the economic activity of the developed markets. This is on a purchasing power parity basis, but it's quite extraordinary. 75% of the world's population lives in emerging markets, and they are growing twice as fast as the developing world. Nevertheless, and in part due to people's home country bias, international allocations are low, but allocations to the emerging markets are very low. And after this sell-off, the valuations for selective emerging markets investments are quite attractive. We believe that the emerging market sell-off has been overdone. In addition to this, we may have a near-term catalyst that creates a better backdrop for emerging markets countries. As a result of the midterm election Democratic control of Congress, we may see Congress reclaim more control over trade as they are constitutionally enabled, and we may see the trade tensions with China in particular ratchet down a little bit with a new political regime in Washington. Current trade concerns have resulted in inventory buildups. This is U.S. industries buying ahead of expected tariffs, and some argue that the underlying growth rate of the United States is only 2%, where in the second quarter there was a greater than $50 billion investment in inventories, and that has pushed the total GDP growth rate well up above 2%, but it's not. Some are arguing that it's not sustainable. And some are arguing starting in the third quarter of 2019, we're going to have a difficult comparison as the inventories have to roll off, and economic growth is going to, on a comparative basis, look slow. In addition to that, there have been headwinds with higher interest rates and energy costs for business. The silver lining on this economic slowdown is it may take some pressure off the U.S. Federal Reserve, where they will be under less pressure to combat an overheated economy, and we may see fewer rate hikes in 2019 than we've seen in 2018. The net effect of this for emerging markets countries would be that as the Fed slows down the rate hikes, the dollar will probably trade lower vis-a-vis other world currencies and become less attractive. The outsized yield differential will shrink. And at present, the U.S. dollar on a purchasing power parity basis is viewed to be overvalued to the tune of 20%. So should the dollar decline relative to other currencies and emerging markets currencies, that would take pressure off emerging market central banks, which have had to raise rates to prevent their own currencies from becoming unbalanced vis-a-vis the dollar. If their currencies weaken enough, it's very inflationary, but if they raise rates too much, it tends to slow economic activity. So if the dollar softens a little bit, that creates a much more benign environment for central bankers in the EM countries. So when you combine all of this, the weaker dollar will aid all non-U.S. equities, but after this sell-off in 2018, emerging markets are particularly attractive, and the weaker dollar should be very beneficial to emerging markets equities. Plus, we believe that the long-term economic prospects for the emerging market sector are extraordinarily compelling. Nevertheless, selectivity is key, and we very much thank you for your time and thank you for listening.